Hello again, we're Sarah and Nathan, founding partners of Meridian, and we're talking to you from our conference room. And we wanted to talk a little bit about market volatility, which is obviously fresh on everyone's mind, including ours. And we think it's important to put it in perspective a little bit. There are a lot of things that the media likes to talk about to get your eyes and ears listening. And so we thought we would touch on some of those topics briefly.
Yeah, real briefly, one of the ones we've noticed that the media tends to pick up on is oil. Oil's up, so the market will be up, or oil's down, so the market's coming down. And historically, that's not very significant because typically they don't move in correlation with one another. And actually, what bothers us as watching this is that really what's going on with oil is more of a supply and a demand issue. Oil isn't telling us anything significant about the markets. What's going on is that pretty much U.S. oil production ramped up so quickly, and OPEC, Russia, Iran, Iraq did not back down on production. And so we just have an oversupply of oil, which has driven prices lower. And that really has no meaningful impact on the stock market in the United States.
Agreed. And another thing that our clients have talked and asked us about is what happens in an election year. And the short answer is really there's not a big trend in either direction. Markets don't like uncertainty. Typically in the last year of a term, which we are in now, where a new president has to be elected, the market does go down an average of about 4%. However, in an election year in general, there's only about a 0.5% difference on the average return. So again, the short answer is no real change in an election year other than markets just don't like uncertainty.
That's true. And speaking of uncertainty, China is another one. The media loves to pick up on the fact that our United States stock market is falling based on fears about China. And what's really interesting about that is that the Chinese economy is so closed that they really haven't allowed a lot of forward investments. They don't import a lot of goods from the United States. We import their goods. And their banking system is government controlled. And so there's really no contagion to be had from China slowing down that should impact the United States to the level that we've seen the stock market decline. So that's just sort of a correlation that we're not really seeing to be true.
And so we think at Meridian, it's important to focus on some of the more important factors that unfortunately the media doesn't like to focus on and we don't hear a lot about. Mm-hmm. And some of those are that gas is very inexpensive. That's a very good thing for our economy. Consumer spending makes up about 70% of our economy, and consumer spending is good. And one of the reasons it is good is because of cheap gas prices. American households continue to have low debt levels, which again helps spending. And historically, we're at a good earnings point where oftentimes the market will go up based on where we are currently in the earnings, season, if you will. So again, I think it's important to focus on those, and we at Meridian want to help you understand how those factors can affect your portfolio.